Alright, this is a paper called Profitability of Momentum Strategies and Evaluation of Alternative Explanations. It's written by Narasimhan Jegadeesh from the University of Illinois and Sheridan Titman from the University of Texas. And it was published in 1999. However, it was published in the Journal of Finance in April of 2001. So a lot of portfolio managers have found that momentum strategies yield significant profits, and in their prior paper, Jegadeesh and Titman found this to be the case, where if you buy stocks with previous high returns over the past 3 to 12 months and sell stocks with poor returns over the same period, you could earn profits of about 1% per month. And so this has been pretty well accepted. However, the debate now is the source of those profits. And so while some people argue that this means the market's inefficient, others have argued that it's merely just compensation for risk, or maybe just data mining on the researcher's part. So in order to combat the data mining criticism, the authors have chosen an out-of-sample period to test whether the momentum strategies still happen, and they found that to be the case. They also find that the January seasonality that they found in their 93 paper still occurs in this new 1990 to 1997 period. And so this is a big deal because other anomalies that happened in the past didn't happen in subsequent out-of-sample periods, such as the small firm effect or the growth stocks outperforming value stocks. And so since this has been confirmed as a persistent anomaly over several periods, we want to really understand its cause. So there have been a lot of authors that have explored behavioral reasons for why momentum profits arise. And others argue that it may be actually rational models where the momentum strategies are being compensated for risk. Following suit with the compensation for risk, Conrad and Kaul found that maybe these profitability momentum strategies could be due just to cross-sectional variations rather than variations in time series. So in that case, stocks that are expected to have high rates of return will realize high rates of return. And so this would happen even if there weren't any volatility over the time. But this obviously conflicts with the prior study of Jegadeesh and Titman in 1993, where they found the first 12 months do well, but the next 2 years do poorly with momentum strategies. And the behavioral models are also in conflict. They found that the momentum profits are due to delayed overreaction of information, which pushes the prices above or below the long-term value. So if that were the case, the returns of losers should exceed the return of winners subsequent to the holding period. However, CK suggests that the higher returns of the winners actually just represents their unconditional expected rates of return. And this predicts that the momentum portfolio returns will be positive on average, no matter the ranking period. So here the authors want to test these conflicting theories by looking at the long-term returns of winner and loser stocks in a momentum portfolio. And so this time they're going to look 60 months following the formation date, whereas their prior paper just looked 36 months out. And they're looking at the 1965 to 1997 period, whereas their prior paper stopped at 1989. And in doing so, they found that the entire cumulative returns subsequent to the first year through the fifth year are negative. So this would support the behavioral models, but it clearly rejects the CK hypothesis, which says that winners should outperform losers based just on their unconditional expected returns. So in performing the research, they state a few cautions in the way interpreting these results. They found that the return reversals did not occur in the second and third year, but rather in the fourth and fifth years over their data. And the strong evidence of the return reversals is in the 65 to 81 period, and it's a lot weaker in the 82 to 97 period. And in the 65 to 81 period, the post-formation returns are significantly negative. However, in the 82 to 97 period, they're essentially zero. And they find that some of this difference is actually due to differences in sizes and book-to-market factor realizations in the differing sub-periods. And with the post-holding returns being negative, it's somewhat surprising because CK found such strong support for the opposite to be true. And so the authors here re-examined the CK study and find a flaw in their design. And in doing so, they find that very little, if any, of the momentum profits are due to the cross-sectional variation in mean returns that CK found. And so the remainder of the paper is as follows. Section 2 provides a brief description of the data and methodology and examines the profitability of the momentum strategies in the 90s. Section 3 provides an analysis of longer horizon returns. Section 4 evaluates the contribution of cross-sectional variation and expected returns to momentum profits. And Section 5 concludes the paper. So let's go on to Section 2, momentum profits in the 1990s. So here we're going to be combating the data mining accusation. And so here they're going to test the 6-month momentum strategy that Jegadeesh and Titman had in their 93 paper that they found to earn 1% per month with a t-statistic of 3.07 over the 65 to 89 period. However, this time they're going to use the same strategy over the 1990 to 1997 period. So they note that the probability of observing a t-statistic that high under the hypothesis of market efficiency is less than 0.11%. So based on that, they observed that market efficiency can probably be rejected. However, the authors cautioned that there were probably many other tests independently carried out that weren't profitable, that weren't reported. And so they note that the test statistic that they have for that particular experiment was very, very abnormal and may have just been the highest out of all the tests that were done over this period. And so the authors note that in isolation, the t-statistic and the results from their prior study appears to have very high significance. However, when you take into account that there were maybe hundreds of other studies, the significance of the Jegadeesh-Titman study may not be as significant or as high. And so really, whether or not to reject the efficient market hypothesis depends on the results of other studies as well, and not just on the Jegadeesh and Titman study in 93. And so here we're going to do an out-of-sample test. And since we don't have the ability to use different types of studies to find the one with the best fit, we greatly reduce our options, and so we can consider our results as being a lot more informative and maybe closer to the truth. So here the authors just replicate the tests that they did in 1993. It includes the New York Stock Exchange and Amex stocks that are priced above $5. And at the end of each month, they rank the stocks according to their past 6-month returns. And then they group the stocks into 10 equally weighted portfolios based on those ranks. And each of the decile portfolios is held for 6 months. And they also calculate the subsequent 13 to 60 month period, which they call the post-holding period. So the formation period is the past 6 months. The holding period is the next 6 months, and 12 months as well. And then the post-holding period is years 2 through 5. And they also note that these portfolios overlap across time. So let's take a look at Table 1, where the results of this study is presented. So in this paper, they've included all of the tables down in the appendix. So let's go down to the first table. And so here we have the monthly returns of each of the different deciles, split up between the 65 and 89 period, the 90 to 97 period, and the 65 to 97 period. The first portfolio is the past winners, which were the top 10% of the stocks with the highest returns over the past 6 months, and the 10th decile is the past losers, the bottom 10% with the lowest past 6 months returns. And down here we have the difference in returns between the past winners and the past losers, and a t-statistic, which is very significant. And so you'll notice in the 6 month holding period past the formation date, the past winners far exceed the returns of the past losers, and they decrease monotonically as the level of prior returns decreases. And this occurs over the 65 to 89 period, which was documented in their 1993 paper, but also over the 90 to 97 period, which is the out of sample period that we're studying here. And then looking at the time period of both of these, the same thing occurs. Although we note that the monotonic relationship is not as pronounced in the 90 to 97 period as it was in the prior study, but over the entire time period it's still there. Okay, so let's go back up to section 2B. The seasonality. So in their 93 paper, Jegadeesh and Titman found that January was a very bad month for momentum profits. And so that January problem could be just a fluke, or there could be a very real downside to investing in momentum strategies in January. So here we're going to look at the out of sample performance to see if maybe January is a real problem. So the results of these tests are down in Table 2. So let's go down and take a look at Table 2. So here we have the same time periods as Table 1, the 65 to 89 period from the 1993 study, and then the new out of sample period of 90 to 97, and then those periods together. And we have the returns of the top portfolio, that's the winners, and the returns of the bottom portfolio, the losers, in the January only, the February to December, that's excluding January, and then all of them for each of these time periods. And then we show the difference of the winners minus the losers portfolio and a t-statistic to see if it's a significant difference. And then here in this column we see the percent of months that the difference between the winner and the loser returns was positive. So in recapping their 65 to 89 period from their 1993 study, the losers' portfolios outperformed the winner portfolios by almost 3% in the January months over that period. However, looking at the out-of-sample new period for this study, that difference is down to a negative 1.21. Still negative, but not as pronounced. And we can see here from this T statistic that this difference is not statistically different than 0. And although that's encouraging, it's still a lot less than the returns that exclude January. And in fact, only 2 of the 8 Januaries had a positive winner minus loser return. And so looking at the periods that exclude January, the previous 65 to 89 period earned about 1.47 in the winner minus loser strategy, and in the out of sample 90 to 97 period, this return was about 1.20 per month. Okay, so let's go back up to section 2C. Portfolio characteristics and abnormal returns. So here we're going to look at the characteristics of the momentum portfolios and the risk-adjusted momentum portfolio returns. This is down in table 3, so let's take a look at table 3. So we have the same deciles as before with the winners and the losers and the difference between the two. The first column is the average decile rank. A rank of 1 means larger firms, and a rank of 10 means smaller firms. So we could say that the more winner portfolios represent portfolios of larger firms, and this makes sense because these winner portfolios over the past 6 months had the best returns, so then their market capitalization is likely pretty high. And we can see on the ends, the top winner portfolio and the top loser portfolio have extreme smaller size companies. And this makes sense because smaller companies are a lot more volatile than larger companies, so then they would likely have the more extreme past 6-month returns. So they end up in the more extreme buckets. So we also here have the Fama-French factor sensitivities, the market beta, as well as the size beta and the value beta. So each of these come from the Fama-French regression 3-factor model. So we could say the level of these determines how sensitive are these portfolios to the market, how sensitive are the returns of these portfolios to the size of the companies, and how sensitive are the returns of these portfolios to being value or growth stocks. And here we use the book to market at the high book to market versus low book to market as the ratio to determine value versus growth. And so for the market, we can see the winner portfolios sensitivity is 1.15, whereas the losers are 1.21. So we could say that the loser portfolios are a lot more sensitive to market returns than the winner portfolio. And in the size factor, the loser portfolios are a lot more sensitive to size than the winner portfolios. And this would make sense in line with the average size decile rank, where we found that the winner portfolios are more composed of larger companies than the loser portfolios. And looking at the high minus low, the loser portfolios exhibit greater sensitivity to distress than the winner portfolio. And this is likely due to the losers having recently had a large decrease in price, so their book to market ratios are a lot higher. Okay, so let's go down to table 4, where we're going to look at the alphas of these strategies. So here we have all the same decile portfolios, as well as the difference between the winners and the losers, and a t-statistic. And here we're calculating the alpha using the CAPM formula, which just includes the market beta, and also the Fama-French regression model, which includes the market beta as well as the size and the value betas. So what we're looking at is what did the portfolio actually return minus what it should have returned based on the regressions. So we see that the alpha for the winner minus loser is about the same as what was found in prior tables with actual raw returns. The alpha difference for the Fama-French model is somewhat larger. So this is because the loser portfolios have a larger sensitivity to the Fama-French factors. Okay, so let's go back up to section 3. The post-holding period returns of momentum portfolios. And so, recapping from the introduction, we can say that momentum profits are consistent with either underreaction or delayed overreaction, and some other authors have called this positive feedback trading. So here we're going to look at the post-holding period returns of the stocks that make up the momentum portfolios in order to look at delayed overreaction in more detail. And in doing so, we will address some of the behavioral models as well as the CK results. Okay, so let's take a look at section 3A, behavioral models. And so the null hypothesis of the post-holding period test is that the momentum profits arise because investors underreact to information, and that information is eventually incorporated into the stock prices. And so from a behavioral perspective, these researchers found a conservatism bias might be in line with that theory, and that same conservatism bias by Edwards in 1968 suggests that individuals underweight new information when they update their priors. And so if that's the case, then prices will tend to slowly adjust to information. And once this information is fully incorporated into the prices, there's no further predictability in stock return. And that interpretation would suggest that post-holding period returns should be zero. However, there's a lot of evidence that suggests that post-holding period returns may in fact be negative. And so a negative post-holding period return would mean that investors overreact to new information, and this has been found in a number of different studies as well. And so to explain this long-term overreaction in conjunction with a shorter-term underreaction, behavioral models such as the representative heuristic are used, and this just means that investors relate events or samples in line with how similar they are to the population. So that may mean that investors might think that since a stock had prior high earnings growth, then it will continue to have that high growth going forward. And so this conservatism bias in conjunction with the representative bias may lead to short-term momentum profits, however, long-term negative returns. Some other authors also attribute this to self-attribution bias, where investors may receive positive signals about a set of stocks, some of which actually do perform very well, but because of their self-attribution bias, they think that the performance of those winners was due to their stock selection skills, and that their losers were actually maybe just bad luck. And so due to their overconfidence and their ability to pick winners, they buy the winning stocks and they push the prices of those winners above their fundamental values. And so later on, when it's discovered the fair values are above the fundamental values, then there's a reversal caused by this delayed overreaction. So Hong and Stein go a different route, which results in the same short-term momentum profits with long-term reversal. So they split up their investor groups into two groups, one of which is the informed traders who considered to be the news watchers. They get signals about future cash flows, but they ignore past prices. The second set of investors would be more of the technical traders who rely more on historical prices, but don't really take into account any fundamental information. So it may be the case that the informed investors have information that is transmitted with a delay and is only partially incorporated to the prices when it's first revealed to the market. And then the technical investors pick up on these price changes and push the prices of the past winners above their fundamental values. And then later these stocks are reversed back to their fundamentals. So both investors groups act rationally, however they have different sets of information. Okay, so let's go down to section 3b, where we talk about the Conrad and Kaul, the CK hypothesis. So CK's hypothesis follows the random walk, where prices of stocks are just random, and then their prices drift and explain the momentum profits. So the profits from a momentum strategy should be the same in any post-ranking period under that hypothesis. And in other words, stocks on the long side of the portfolio should continue to outperform stocks on the short time by the same magnitude in any post-ranking period. Okay, so let's go and look at the post-holding period evidence in section 3C. It looks like figure 1 summarizes CK's study with the underreaction, the overreaction, and the price correction. So let's go down to figure 1. So as was discussed before, under the CK hypothesis, the cumulative returns should continue far out past the holding period. And then the hypothesis where investors merely underreact, where we have momentum profits in the holding period and then nothing over the post-holding period. And we also have the overreaction and price correction hypothesis, where we have momentum profits in the holding period, and then we have negative profits over the subsequent period to correct for the overreaction and bring back to fundamental values. And so let's go back up to the discussion. And to test each of those three hypotheses, we're going to examine the returns following the initial formation date. So at this point, we don't really have any guidance as far as how far out the post-holding period should be. However, Jegadeesh and Titman's 93 paper looked 3 years out after the formation date, which seems like a reasonable amount of time for information to be impounded into prices. However, recent studies related to IPOs and equity offerings find that it takes sometimes 5 years for certain events to be baked into stock prices. So here we're going to extend the holding period to 5 years, and this information is presented in Figure 2. So let's go down to Figure 2. So here we have the post-formation cumulative returns. So the formation date would be at 0, which goes all the way up 60 months. We also have different time periods. So this darker line is the 1965 to 97 period. The dash is 65 to 81, and the more granulated dash is 82 to 97. So in the 65 to 97 period, we see a dramatic reversal of returns in the first year and then the next 4 years. We can see in all time periods, pretty much the first year, the monthly returns increase monotonically. However, from month 13 to 60, the monthly returns are on average negative. And you can see by the end of the 60th month, the cumulative return over 5 years is about 1%, which nearly completely wiped out the momentum profits that were earned in the first year. And so under the CK hypothesis, if the difference between the winner and loser portfolios here was due to a difference in unconditional risk, we would expect these high returns in the first 12 months to continue far out past the first year, and by the end of the 60th month, this 10% return should be about 60%. But we see the opposite here, where the return goes up in the first year and then down over the next 4 years. So we can maybe conclude that the CK hypothesis is not true. So Table 5 has some more information related to these 5-year returns. So let's go up to Table 5. So here we have the same table as we've seen before. We have different population periods here, and we have the holding period split into the 1-year groups. We can see in all cases the first year returns of winner minus losers are highly positive, right around 1% per month average returns. However, in the second year, the returns are negative in most cases. And so we could say that the momentum profits earned in the first year are pretty much completely reversed by the end of the 5th year. And so this is consistent with the behavioral models as discussed before. And going up to Table 5, we have some more information about the seasonality of these momentum profits. As was previously found, January is a negative month for the momentum strategy. And if you remember from Table 2, the loser portfolios have a greater sensitivity to the size and book to market factors. And here we've got it split into January and excluding January. And here we have that the factor exposures for January compared to excluding January months. So we can see in January the momentum returns are a lot more sensitive to the three-factor model in January than they are in the other months. So then we would say that since the returns are a lot more sensitive in January, then if the negative returns in these subsequent months should largely come during January. And we see that that's most certainly the case. And then going down to panel C, we have the Fama-French three-factor alphas. And we see in January those are also negative. So we see from all portfolios, only years 4 and 5 are statistically significant. Therefore, at least part of the differences between winners and losers can be attributable to the factor sensitivities. So to test the robustness of this result, we've also split the periods up, and so let's go back down to table 5A. With the Fama-French factors over the 65 to 81 period, as well as the 82 to 97 period. So we see in the 65 to 81 period, the size and value factors were a lot more sensitive in this period than in the 82 to 97 period. And so we can see that the momentum strategy is highly profitable in the first year for each of the time periods. However, the returns are quite different in the subsequent years between the two different periods. And so in the 65 to 81 period, the first year's profits are nearly split in half by the end of the third year, and then actually show about negative 5% by the end of the fifth year. And in the 82 to 97 period, we have about the same profit as the 65 to 81 period. However, the decline in the subsequent years is not as pronounced as it was in the 65 to 81 period. So to sum this up, these figures fall in line with the behavioral hypothesis where the momentum profits earned in the first year should eventually be completely reversed. However, at issue here, the fourth and fifth years are the ones that have the largest declines to cause the reversal, while there's much less evidence for reversal in the second and third years. And in addition, a large part of the reversals happens in the month of January, whereas most of the gains from the strategy happen in non-January months. And finally, the evidence for reversals is high in total. However, when splitting up into these sub-periods, the evidence for reversal isn't as robust in the 82 to 97 period as it was in the 65 to 81 period.